So you might think you're facing a genuinely tough, independent decision tonight.
Right, like where to eat.
Exactly. You're sitting there debating with your partner, trying to choose between uh, a loud, casual Tex-Mex dinner or maybe an endless parade of soup and salad at that familiar Italian spot.
Oh, the classic
Yeah,
breadsticks.
exactly. Or maybe you're celebrating a massive promotion and want to drop some serious money at a dimly lit high-end steakhouse. It really feels like you were choosing between entirely different culinary
Oh, it
universes.
does feel that way, yeah.
But there is an incredibly high probability that every single one of those seemingly distinct choices leads directly to the exact same corporate bank account. Welcome to the Deep Dive. I'm Jack.
And I'm Misha.
Today, we are opening up the financial hood on a true leviathan of the American dining landscape.
We really are. We've got our hands on Darden Restaurants' massive 2025 annual report.
And this is the Form 10K, right, for the fiscal year ending in May 2025.
That's the one. And I mean, when you really dig into a financial disclosure of this magnitude, you quickly realize you aren't looking at a food company at all.
No, not at all. We aren't just going to read you a menu today. The mission here is to figure out how a single corporate entity manages to pull in over $12 billion in a single year.
12.08 billion to be
Oof.
exact.
Selling everything from like $20 enchiladas to $150 dry-aged steaks. So we are going to break down their fiercely centralized business model and unpack why they actually want you to trade up and down their restaurant tiers.
And we'll also follow the actual physical cash. We're going to see how they engineered massive profits in 2025, especially compared to 2024 in an industry that is notoriously brutal.
Exactly. So before we can understand the billions of dollars flowing through this company, we need to look at what they're actually selling to you, the listener, and who exactly is sitting in their booths.
Yeah, let's look at the portfolio. Darden operates an astonishing 2,159 restaurants.
Which is just a staggering footprint.
It really is. But they don't just stamp out the exact same building 2,000 times. They have engineered a highly deliberate, structured hierarchy of brands. It's designed to capture a specific demographic at a very specific moment in time.
Right. Let's build that pyramid for everyone listening, starting at the foundation.
Good place to start.
At the base, you have what they consider the value tier. This includes Cheddar's Scratch Kitchen, which sits at about I think a $19 average check per person.
Yeah, roughly 19 bucks. They're famous for those massive honey butter croissants.
Oh, those are dangerously good. And recently, they aggressively expanded this tier by acquiring Choose in 2025.
Right, the Tex-Mex chain.
Exactly. Choosie's sits right at a $19.50 average check, leaning hard into that quirky, authentic Tex-Mex space.
So that's the base. Moving up from there, you enter the engine room of the whole company, which is the casual mainstays.
This is where the heavy hitters live.
Oh, absolutely. This is where you find Olive Garden. I mean, it is the absolute behemoth of their portfolio, famous for the unlimited salad and breadsticks. That comes in at a $24 average check.
And sitting right next to it in that middle tier is Longhorn Steakhouse, right?
Yes. Slightly more expensive at a $28 average check, capturing that casual dinger crowd perfectly.
Okay, so then you step up into what feels like a completely different world, like the fine dining and specialty tier.
Yeah, this is where the margins get really interesting.
First, there's Yard House, where you're dropping an average of $36 a person. You go there for the classic rock vibe and, the sheer volume of draft beers on tap.
Tons of beer. But if you keep climbing, you hit the true luxury experiences.
Right, like the Capitol Grill.
Exactly. The Capitol Grill commands a $104 average check for an award-winning wine list and steaks. And at the absolute peak is Eddie V's.
Prime seafood, right?
Yep, where a night of live jazz and prime seafood will run you about $123 a person.
Which is wild. Looking at this massive spread, it feels incredibly similar to like scrolling through a streaming platform, agonizing over what to watch, only to realize Disney owns every single studio on the screen.
That is a perfect analogy.
It's a brilliant illusion of choice. You walk into a Choose, and their literal company motto is, if you've seen one Choose, you've seen one Choose.
Right. They really push that unique independent angle.
They do. The decor is eccentric. It feels local. It feels totally unchained. But you're actually stepping into a meticulously calculated, highly optimized corporate matrix.
And that matrix is the absolute core of their customer strategy. I mean, Darden isn't relying on a single demographic.
Because that would be too risky, right?
Exactly. Think about it. If they only owned Olive Garden, a recession might wipe them out as middle-class families tighten their belts.
Right.
And if they only owned the Capitol Grill, they would be incredibly vulnerable to corporate expense accounts drying up during a downturn.
So by owning the entire pyramid, they capture you at every single economic level and life occasion.
You nailed it. If inflation hits hard, maybe a family trades down from Longhorn to Cheddar's. Or if someone gets a massive year-end bonus, they trade up from Yard House to Eddie V's.
So no matter how your financial life fluctuates, your money never actually leaves the Darden ecosystem.
It stays right in the family, which means they can track your behavior across all those milestones.
Right, because if I use the same credit card or join the same rewards program, they're quietly building a profile. They know I eat cheap Tex-Mex on random Tuesdays, but drop serious cash on seafood every October for my anniversary.
Exactly. They utilize customized customer relationship marketing fueled by, decades of visit history data.
That's a lot of data.
It is. And because the portfolio is so diverse, they can cross-promote seamlessly. It's highly sophisticated data harvesting, just disguised as hospitality.
Which is slightly terrifying, but brilliant. But that raises a massive logistical question for me.
Okay, what's that?
How do you run a $100 hushed, elegant steakhouse and a chaotic, family-packed breadstick factory under the exact same corporate umbrella without the entire operation just imploding? I mean, the back-end operations for those two environments couldn't be more different.
Well, the secret to managing that paradox is a fiercely centralized business model.
Okay, break that down for me.
So Darden operates entirely in the full-service dining segment, which just means restaurants with waitstaff. That specific segment is historically super fragmented.
Like lots of vulnerable, independent mom-and-pop restaurants.
Exactly. Or small regional chains. Darden's strategy is to bring massive, undeniable corporate scale to what is basically a neighborhood-level fight.
Right, they bring a bazooka to a knife fight.
Basically, yeah. Let's look at the supply chain as the prime example. They utilize a system called Darden Direct Distribution.
So they aren't just buying from the local farmers market.
Not even close. They are sourcing food and supplies from over 1,400 suppliers scattered across 30 different countries. And all of that flows into a single, unified back-end system.
Oh, I see. So when global tomato prices spike by, say, 20% because of a drought, the local independent Italian spot down the street either has to hike the price of their marinara sauce instantly or eat the loss and risk bankruptcy.
Exactly. They have no buffer.
But Darden can just leverage its global purchasing power, renegotiate a bulk contract across its thousands of restaurants, and absorb the hit without the diner ever noticing.
Right. They are moving global agricultural markets, not just buying groceries.
That is the exact mechanism that gives them a competitive moat.
It really is. And they apply that same philosophy of scale to their physical footprint, too. This is fascinating. Out of their 2,159 locations, 2,065 of them are leased.
Wait, really?
Yes. They purposefully choose not to own the dirt under the vast majority of the restaurants.
Okay, I have to challenge that approach.
Go for it.
Signing over 2,000 commercial leases sounds like building an empire on quicksand. Well, if a neighborhood suddenly goes downhill or a new highway diverts all the traffic away from a shopping center, you can't just sell the land and walk away. You are legally trapped, bleeding cash, paying rent for a ghost town.
You're not wrong. It is a massive liability on paper. But that vulnerability is actually intentionally engineered to function as an engine for operational excellence.
Wait, how does a massive liability make them excellent?
Because they are locked into these long-term lease commitments, Darden's management simply cannot afford to be complacent. They have a system in place to ruthlessly review underperforming locations.
They can't just ignore a bad restaurant.
Right. If a specific restaurant falls below their minimum profit standards, they deploy resources to aggressively fix the local management.
And if the demographics have truly shifted and it just cannot be saved.
Then they might convert that building into a different brand from their portfolio that better fits the new neighborhood.
Oh, so swap the Olive Garden for Longhorn.
Exactly. And if all else fails, they make the incredibly hard choice to permanently close it and take the financial hit rather than let it slowly drain resources for years.
So leasing allows them to expand incredibly fast without tying up billions in real estate, but it demands an almost like militant level of internal discipline to manage the risk.
That's a great way to put it, militant discipline.
But You can't maintain that kind of militant operational discipline if the people actually running the restaurants are constantly quitting.
This is a huge point.
Right. Because the restaurant industry is famous for treating its workforce as completely disposable. Turnover rates routinely approach 100%. People burn out and walk away constantly.
That's the industry standard, unfortunately.
The numbers in this 10K report completely defy gravity. Darden's hourly turnover is 67%, and their management turnover is sitting at a stunning 16%.
Which is unheard of.
Seriously, in this industry, keeping 84% of your managers year over year is practically science fiction. How are they doing that?
Well, it's a massive statistical outlier, like you said, and it is the direct result of heavy, heavy investment in retention.
Okay, what kind of investment?
Across all of their brands, their hourly workers average $24 an hour, and that's inclusive of tips.
That's solid. But a competitive hourly wage isn't enough to keep a restaurant manager from burning out. The hours are brutal.
Right, so they go further. Darden subsidizes between 75 and 81% of the health premiums for their team members.
Wow.
And it's a contribution they have actively increased over the last few years.
That's huge. And I read they also fund next course scholarships for the children of their employees, right?
Yes, and they run a fast fluency program to teach English for free.
Which is super smart.
But maybe the most unique thing is something called Darden Dimes.
Oh, right, the emergency fund.
Yeah, it's a team member emergency grant fund. Employees can donate just 10 cents from their paycheck to a pool that helps coworkers facing unexpected life emergencies, like a house fire or a sudden medical crisis.
And did that raise a massive amount of money recently?
In 2025 alone, that internal fund raised over $2.5 million.
That is incredible. I used to look at corporate perks like emergency funds or free English classes as just PR fluff, like something to put on a glossy recruiting brochure.
Right. A lot of companies do it just for the optics.
Exactly. But analyzing this business model, treating employees decently, is actually a ruthless capitalist strategy for maintaining high margins.
How do you mean?
Because the cost of a manager walking out the door isn't just the price of a help-wanted ad. It's the chaos in the kitchen, the wasted food, the alienated regular customers, and the thousands of dollars spent training a replacement.
Oh, the friction is incredibly expensive.
Right, so they're spending dimes on health premiums and grants to save absolute fortunes on turnover friction. And because of that, they've built a culture where, 99% of new general managers are internal promotions.
Exactly. That internal pipeline is their secret weapon. You don't have to teach an external hire the Darden system. You just promote someone who has lived and breathed it for 5 years.
Okay, so we have an incredible supply chain, a highly disciplined real estate strategy, and a fiercely loyal workforce.
The trifecta.
But did this massive centralized machine actually print money in 2025? Because let's be real, the broader economy hasn't exactly been easy on the consumer lately. Let's look at the actual scorecard and compare it to 2024.
Oh, the machine definitely delivered. On the top line, total sales hit $12.08 billion in 2025.
$12 billion.
Yep, that is a solid 6% increase from the roughly $11.39 billion they generated in 2024.
$12 billion worth of steaks, breadsticks, and margaritas in a single year. That's hard to even picture, but how much of that actually made it to the bottom line?
Well, net earnings from continuing operations rose 2%, crossing the billion-dollar mark to settle at $1.05 billion.
Okay, so they are growing. But where is that growth physically coming from? Are they just slapping down new Olive Gardens on every highway exit to juice the numbers? Or are the existing restaurants actually becoming more popular?
It actually requires a combination of both to hit that 6% overall growth.
Okay, break that down.
First, they achieved a 2% blended increase in what the industry calls same restaurant sales.
That's a critical metric.
It is. It basically means that if you look exclusively at the restaurants that were already open last year, diners walked in and spent 2% more money this year.
Okay, so existing stores did better. And the rest?
Second, they layered physical expansion on top of that. They added 103 company-owned Choose locations through the new acquisition.
Oh, right, that bulk addition.
Exactly. And they physically built 25 other new restaurants across their legacy brands.
Okay, here is the part of the profit breakdown that completely stops me in my tracks, though.
Which part?
When you look at their margins, comparing 2024 to 2025, everyone knows inflation has been a massive headache.
Oh, absolutely brutal for restaurants.
Right. The cost of beef, the cost of wheat, the cost of labor, it's all been climbing. But despite global inflation, Darden's food and beverage costs and their labor costs actually decreased as a percentage of total sales.
Yeah, that surprised a lot of analysts.
The report explicitly credits this to pricing leverage and productivity improvements.
Yeah.
Let's demystify pricing leverage for a second.
Sure.
Does that just mean they slowly boil the frog, like raising the price of a chicken parmigiana by 50 cents every few months so we don't really notice? But it perfectly covers their own rising costs.
Yeah, I mean, strategic price increases are definitely the primary component of pricing leverage. The report openly notes that Olive Garden's average check size grew by over 4%, largely due to pricing adjustments.
So they just hiked the prices of my breadsticks to beat inflation.
Basically, yes, but they have the data. They know exactly how much they can raise the price of a meal before a customer finally decides to just stay home.
The breaking point.
Right. However, they aren't just hiking prices to cover inefficiency. It connects back to that Darden direct distribution system we discussed earlier.
The global supply chain.
Yes. Because they are negotiating on a massive global scale, their raw commodity costs rise much slower than the rest of the market. They negotiate smarter, they retain staff better, so training costs are lower, and they raise prices just enough to outpace the inflation they couldn't avoid.
That is surgically precise. But the scorecard wasn't entirely flawless, right? The report shows that while food and labor costs went down relative to sales, a category called restaurant expenses actually went up.
Good catch. Yes, they absolutely faced headwinds there. General inflation hit their utility and maintenance costs pretty hard.
Makes sense.
Plus, they had to absorb the heavy one-time costs of physically integrating the 103 newly acquired Choose restaurants into their corporate backend.
All right, getting them on the same software and all that.
Exactly. And significantly, they incurred new fees from rolling out an exclusive delivery arrangement with Uber.
The Uber Direct partnership.
Yeah.
They rolled that out to almost every Olive Garden and started implementing it at Cheddar's. It's a really interesting setup because you still order through the Olive Garden app, right?
All right.
So Darden keeps your consumer data. They don't give that up. But an Uber driver actually drops the food at your door. They outsource the physical logistics, but they obviously have to pay Uber for the privilege, which eats into the margin.
Exactly. Outsourcing delivery logistics is expensive, but managing an internal fleet of delivery drivers is a nightmare they clearly wanted to avoid at all costs.
Smart move. Now, there was one other massive hit on the 2025 receipt, a line item called Impairments and Disposal of Assets. It jumped to over $49 million,
A huge jump.
right? Because to put that in perspective, in 2024, that number was only $12 million.
Yeah, a $49 million write-off is not insignificant. And that connects perfectly to our debate about the commercial leases earlier.
Ah, this is the consequence of that militant discipline, isn't it?
Precisely. Darden made the grueling, incredibly expensive call to permanently close 22 underperforming restaurants in the fourth quarter of 2025.
So they just cut the dead weight.
They had to. But when you close a lease location, you usually have to write off the value of the kitchen equipment, the custom renovations, and sometimes you have to pay severe penalties to exit the lease early.
Ouch.
So they willingly took a $49 million hit to the chin to surgically remove the failing locations and protect the overall health of the entire portfolio.
Which brings us to the ultimate truth teller in any business analysis, the cash.
Yes, the cash flow statement.
Because pricing leverage and net earnings and impairments, those are all accounting concepts. They can be smoothed out on a spreadsheet by clever accountants. But to truly understand if a business is thriving, you have to abandon the jargon and follow the physical dollars.
You have to follow the money.
Exactly. If they're pulling in over $12 billion in sales, where's the actual cash ending up? Let's open the bank vault.
Let's do it. So a company's statement of cash flows is traditionally divided into three distinct buckets: operating, investing, and financing.
Okay, let's start with operating cash flow, which is just the money generated strictly from running the actual restaurants, right?
Right, and Darden is a cash-generating leviathan here. They pulled in $1.71 billion in pure cash straight from restaurant operations in 2025.
Right.
And that is up from $1.62 billion in 2024. So it proves that their higher net earnings actually translated into real physical dollars in the bank.
So they have $1.7 billion flowing through the front door from diners paying their tabs. But a corporation isn't a savings account. They can't just let that cash sit there losing value to inflation. Where is all that money going to ensure they don't stagnate?
That takes us to the second bucket, investing cash flow. They deployed $1.3 billion into investing activities in 2025.
So they aren't hoarding it. They are aggressively buying future growth.
Absolutely. A massive chunk of that, over $613 million in net cash, was spent instantly to acquire Choose.
Just writing a massive check for a new chain?
Yeah. And beyond the acquisition, they spent another $644 million building brand new restaurants from the ground up, modernizing the interiors of older locations, and upgrading their enterprise software.
Watching this cash flow strategy really reminds me of playing Monopoly.
Okay, how so?
You don't just hoard the $200 you get for pass and go.
Yeah.
The moment you get cash, you immediately plow it into buying the orange properties so you can build houses on them so you can charge the next player more rent.
Right, you have to spend it to grow.
Exactly. Which gives you the cash to buy the green properties. They are using the cash from their established restaurants to constantly expand their board.
That is the perfect analogy. And that brings us to the final bucket, financing cash flow.
Okay, what's in this one?
This section tracks how Darden interacts with its shareholders and its lenders. In 2025, they used $385.8 million here, heavily focused on rewarding the people who own their stock.
How much did they hand out?
They paid out over $658 million in direct cash dividends. And on top of that, they spent over $418 million buying back their own stock from the open market.
Which reduces the number of shares out there and makes the remaining shares inherently more valuable.
Exactly.
Wait, let me pause you there because the math is completely colliding in my head.
Uh-oh. What's wrong?
You just said they paid out $658 million in dividends, plus another $418 million buying back stock. That is well over $1 billion handed out to Wall Street.
Right.
But if you look at the total line for financing cash flow, you said they only used a net of about $385 million. Did they find a duffel bag full of cash in an alleyway to make up the difference?
Not quite. They balanced the scales by taking on debt.
Oh, there it is.
To offset those massive payouts, Darden took on $750 million in new long-term debt. Specifically, they issued new senior notes to help fund the all-cash acquisition of cheese.
Okay, let's translate senior notes for everyone. That is essentially just Wall Street terminology for selling corporate bonds, correct?
That's right.
Investors give Darden cash right now, and Darden hands them a note promising to pay that cash back with a set interest rate over the next decade.
Exactly right. It is a formalized IOU to the bond market.
But taking on $750 million in new debt just to buy a Tex-Mex chain sounds incredibly risky on the surface. If consumer spending plummets, that interest payment is still due every single month.
And it would be terrifying for a regional chain, but for Darden, it is entirely calculated.
How do they justify it?
The financial community measures this risk using a metric called adjusted debt to EBITDA.
Okay, let's decode that alphabet soup.
Sure. EBITDA stands for earnings before interest, taxes, depreciation, amortization, and rent.
So it's essentially a measure of how much raw, unvarnished cash the business generates before they have to pay the banker, the taxman, or the landlord.
Exactly. And Darden's adjusted debt to EBITDA ratio sits at a very healthy 2.1. This means their debt is highly manageable relative to the colossal amount of cash they generate. Their ability to seamlessly raise $750 million in the bond market proves that institutional investors have total faith in their model.
Wow.
They essentially use the massive, reliable cash flow from saturated, mature brands like Olive Garden to safely take on debt, buy high-growth targets like cheese, and keep the monopoly game going indefinitely.
So their financial strategy is basically the ultimate corporate balance diet. They gorge on cash from diners, digest it by buying up competitors like Chews, and then serve a massive dessert of dividends to their shareholders.
That's a great way to summarize it. It's a perpetual financial engine.
They are literally using the endless breadsticks to finance the endless chips and salsa.
That's literally what's happening.
We have covered a massive amount of ground today. We started with a seemingly simple decision about where to eat dinner tonight and ended up mapping the architecture of a $12 billion corporate machine.
It's a lot to digest.
It really is. The next time you sit down and order a ribeye at Longhorn, or grab a booth at Cheddar's, or take the family out to Olive Garden, you aren't just paying for a meal. You are actively participating in a highly optimized, meticulously calculated ecosystem.
You're part of the matrix.
Exactly.
Yeah.
You are a data point in a model that perfectly balances global supply chain dominance with localized, quirky branding. Your check is helping to pay the dividend yields, and your dessert is funding their next massive acquisition.
It completely reframes how you look at a menu. And, I want to leave everyone with a final, broader thought to ponder on that note.
Lay it on us.
We discussed Darden leaning into digital data analytics, and we explored their new exclusive delivery integration with Uber. Think about the long-term implications of that combination.
Okay.
If a single corporate entity knows exactly what you eat for budget lunch, what you crave for a midweek family dinner, and what specific wine you order to celebrate an anniversary, and they can now use an algorithm to dispatch an Uber driver to bring it straight to your door. Are we heading toward a future where dining out is no longer about discovering culinary art, but rather about algorithms perfectly optimizing our cravings before we even consciously know we have them?
That is a fascinating, slightly unsettling reality to end on.
Mm-hmm.
The algorithm knows I want a honey butter croissant before I've even opened the app.
Pretty much.
Thanks for joining us for this deep dive. Keep questioning the systems behind the world around you, even when you're just out for dinner. Catch you next time.